Well, good afternoon. And today we're going to be looking at, as you can see, we already have the 8 drivers up on the screen. And one of the things that is helpful with Ed's vast experience in both operations and finance, today he's going to go and look at in a lot of detail about how to optimize your balance sheet and cash flow. I'm excited about hearing this. Ed does a great job. Ed, with that, I'm going to pass it on to you.
Okay, well, thank you, Ray. And again, briefly, we have 8 drivers that we use as a team for optimizing the value of a business. And today, we are going to talk about the 6th one from going clockwise from the top, and it's called optimizing the balance sheet and cash flow. And here's a slide that kind of gives more detail on it. But this is a driver that very often is not even considered in an evaluation of a business. And it's, as you will see as we go through this thing, it is extremely important for finding opportunities to make your business more profitable. And so I'm excited about talking about it. So let's get started. Number one is to free up working capital, and very few people truly look at this. Working capital is current assets minus current liabilities, and it's necessary for growing a business. Usually, when you grow your revenue, you're also growing your working capital. So it requires more capital to run your business, the bigger that it gets. And it's really an opportunity to really take away some of that need of capital and invest it in projects that make money. So we're going to be talking a little bit under freeing up working capital about knowing your business better and putting your money to work. And it starts at the beginning, and it's how you recognize revenue. If you can recognize revenue earlier in the process and collect your receivables sooner, you're going to have a profound impact on your receivables, and you're going to have a profound impact on cash flow coming into the business. Another little trick of the trade that comes into play a lot of times is you have to ask for customer deposits when it makes sense. A lot of times customer put in orders and it takes several months to get these orders prepared, and they understand you're trying to get them the best price. They'll be able to give you some capital up front as a deposit to move the order forward. Inventories are extremely important. Most of the time inventories are overstated. There's too much. And the better you can be in operating your inventories and minimizing them, and you have better turnover of your inventories based upon your sales, the lower your working capital will be, freeing up capital for other things. And the last thing is in your accounts payable, you want to pay your vendors, but sometimes you can pay your vendors a little bit later in the process. They know they're going to get their money, but you negotiate that up front and you pay them later, and that would also help you free up working capital. So that's the first of the 7 steps here for optimizing the balance sheet. The second one is extremely important, and I think COVID-19 hit a lot of people on the head with this one, because bottom line is when there's a crisis and you need money, that's not the time to be asking the bank for money. Basically, you want to develop a good relationship with your bank. You want to bid the process out and make sure you're getting a good deal. But most importantly, you want your bank to treat you with respect and treat you like a valued customer. So that's all done by dialogue and communication and talking about the banking relationship, what the bank can give you more for your business, which adds value to your bottom line. You're optimizing your line of credit, increase it more. A lot of times the devil's in the details, so you got to make sure that they are giving you credit for all the receivables, accounts receivables on your balance sheet. A lot of times they want to reduce it to like 30 days past due, and that's it. Anything above that, they wouldn't count in your line of credit. You want to obviously get the best interest rate out there, and you want to make sure that you have workable covenants with them. These are requirements that they demand that make sure that you're in compliance with what they're expecting. And so that's really important to negotiate up front as part of this process. A lot of people don't spend a lot of time on this, and you're leaving a lot of dollars on the table by not spending time with your banker. A lot of times we will look at 2 or 3 different banks and see which one wants the client's business the most. And if based on that, we will develop a banking relationship. Sometimes banks, just like any other business, they assume they have your business forever, and they aren't really willing to give you anything more of incremental value. So therefore, you have to go to the outside and take a look at what's available.
Ed, can you give us an example of covenants that you are careful about trying to help your clients either avoid or minimize?
Well, I want to make sure that based upon their forecasts for their business, that looking down the road, that there aren't going to be any problems with any of the requirements that the bank is setting. And that just requires a little forecasting and running the numbers through the metrics to make sure that you're meeting their expectations. Banks don't like surprises. And if you happen to get out of, if you're non-compliant with one of the covenants, it's okay, but you gotta call them, let them know in advance. It's a great opportunity to develop a great relationship with them. But bottom line is, you'll see which ones are not in accordance to what you need to do your business by doing some forecasting and projecting your numbers out forward.
Can I ask another question, Ed? You know, one of the because you've had so much experience in selecting banks, from having worked with both large national banks and smaller community banks, what's been your experience in terms of which is probably preferable for, you know, a small business who's trying to, you know, maximize this cash flow?
Boy, that's a great question, Ray. And I think if it's a really small business, I think the smaller banks are more in tune to servicing them. If you're a moderately sized business, then you get into more options of banks that are more apropos for your line of business. But you really find this out when you do a bid and you have several banks come in and see what they are willing to do for you. And it becomes very apparent which ones want your business and which ones don't. And the ones that want your business, they're really gonna step up when you need them. The ones that don't want your business, they're just gonna come in and basically give you a boilerplate presentation, and you're gonna know that they're not thinking of you as a special client. But you definitely want to be a special client so that you get full service from the bank that you love. Another trick of the trade is to look at leases rather than purchasing equipment or vehicles, and especially with vehicles. I really like the opportunity of having a full service lease for my vehicles. Most companies don't have the expertise in-house to maintain their fleet properly. And when you deal with a big outfit that does that full time for a living, you usually get a better deal. And most of all, you don't need the money up front to buy the assets. You can spread it over 7 years, and it really helps your balance sheet and your profitability. So the third avenue of opportunity here is to strengthen your balance sheet and review equity opportunities. Now, how many people ever talk about that when they're evaluating a business. But it definitely, you have to be on the lookout for all opportunities. And if there are potential investors, minority investors that want to invest in your business, you should consider that. And what's really nice about that, you're bringing in new blood, new money to help fund future investment opportunities for the company. It's also a possibility for a potential future buyer. Buyers, they want to invest in a company, but they want to understand it so they can make a limited investment in the company, be part of the board of directors, understand the business, and then when it's time for you to move on and you want to sell your business, they could be a potential buyer of the business. And I think it's also important to be strong. You have to make money. You can't continually lose money. You want to make money, and you don't want to take too much money out. You want to keep investing back in the business, and that strengthens your balance sheet. So that's also important. And there are a bunch of benchmark ratios on balance sheets. And a lot of these ratios compare not only the balance sheet, but they compare it to the income statement. And those ratios need to be calculated every month, and you need to understand them. They're basically into three categories. One is liquidity. The second one is capital leverage. And the third one is asset management. And asset management is particularly important when you're evaluating management. You want to lower your average collection period. You want to increase your working capital turnover, and you want to increase your inventory turnover. And hopefully down the road, we're going to have another session about the balance sheet. We'll get into the balance sheet in more detail, and we'll give examples on these various ratios and how important they are of looking at the progress of the company and evaluating the management team.
Ed, let me ask you a question there on the strengthening the balance sheet. Talk a little bit about how small businesses tend to make money, loan it back to the business, back and forth. They leave it in a long time, and then the IRS comes along and says, no, that's not really a loan anymore. Or utilizing earnings and loans and turning them into stock or equity and increasing the strength of the balance sheet that way versus taking all the money out.
Well, there's a lot of transactions that go on in a business between the shareholders and the business, where money is taken out of the business and given to the shareholder, and it's treated as a loan back to the business. And this stuff happens all the time, and you got to be careful that the IRS doesn't come back and say that was not a loan, that was a dividend. Because if it's a dividend, there's a tax consequence associated, whereas with a loan, there is not.
Right.
So you really have to make sure you're above board and you're treating your business with controls and good stewardship, so that you limit these potential abuses from happening. And a lot of times the owner of the company thinks he's above and beyond normal due diligence, and he'll go in and pull money out and and hopefully return it somewhere down the road. And those are issues that are of grave concern to the company that could cause a lot of problems down the road.
A lot of very small businesses kind of mix up their accounts. Even I've run into some very small clients who don't even have separate bank accounts for their business. They just, they kind of use one checking account, and they say, well, it's all my money anyway. But then they can't figure out what's going on, and you end up having your costs are mixed up. They're putting personal costs in the business that many times are not really deductible. So they just don't keep very good track of that. And then the same thing seems to go on where you're borrowing. And it's actually kind of difficult sometimes to figure out, well, how much was that profit, and how much was that you just put money back into the business as a loan? And did you write a formal note so that it's really clear to everybody that this was a loan? That tends to get really messed up in very small businesses, and some of them not so small, where they're entrepreneurships that, well, I should say they're just personal businesses where they may do very well and be dealing with hundreds of thousands of dollars in business, but they're still only using one pocket to put the money in and take it out.
Yeah, I think you bring up a very good point, Ron. You really have to keep the two separate. Normally, the business is either an S corporation or a C corporation or a LLC, a separate business entity. And by law, it's required the funds to be kept separate from ownership. So it's a separate, entirely legal entity. So you have to keep the two separate. And I can see people trying to save money on not incorporating their business. But I think when you get to a certain point, running everything through your checkbook, this doesn't make a lot of sense.
What do you think that point? What's that certain point? What is that?
I think anywhere where you start making $100,000 a year in anything, I really believe you should have your own separate corporation set up, legal.
Yeah, okay.
Ed, because I know Ron is more attuned to this than I am. Could you help our listener kind of get a better sense as to how quickly could you go through an organization like this and give them a sense as to what they need to do to kind of move forward?
Well, I like the idea. I think in one day you go in and analyze the information. You can come up with a pretty good playbook on opportunities that they're missing at the corporation, and ways they could better manage the corporation. And then I think after that, you have a dialogue with the owner and the management team, and you build from that. And that's where I think the real value is. But I think a business owner, it's worth their effort to have somebody come in for a day and go through their numbers, go through their operations, and give them a report on potential opportunities. And as we all know, once you come up with the playbook, the more people that are involved in the collaboration of that playbook, the better the results are going to be, especially if you hold them accountable with some type of a quarterly meeting where you assess and evaluate the progress of the company and make adjustments to the strategic plan accordingly. So there's a lot of value, but it starts with a report, and it shows the owner where the potential opportunities are. And after that, it's an ongoing process. It's not just a one meeting after that. It's probably 4 meetings a year, fine-tuning the operations to get the full value out of the new revised playbook.
And what do you say to some of these small businesses that actually have an attitude that they don't want anybody to know what's going on. They don't want the government to know what's going on. They don't want their wife to know what's going on. They pretty much think that the less clear it is, the better, so that they can kind of put some money in the mattress, maybe skim a little bit. What's your comment for those kind of businesses?
Well, I'm probably as squeaky clean as you can get. I'm a CPA by training. I really believe in doing things by the book. When people complain about taxes, I'm pretty much, and if they've got a good tax plan in effect, I pretty much say you're very fortunate to be able to pay your taxes. It means you're making a lot of money.
Yeah.
And this goes on all the time because people don't want to pay tax. They want to make all the money and they
Right.
want to hide everything. And I try to emphasize these folks, you want to sleep at night. And in addition to that, you want to sell your business eventually. And you don't want to have these problems come up because you weren't doing things correctly.
Right.
And to me, you do things by the book. You take full advantage of all opportunities. You operate in the gray, but you don't operate in the black. It's either you can't do things that are intentionally wrong and try to say that it's a mistake, because it just isn't going to happen. And CPAs, your trusted advisors, they're under these requirements. They have to make sure you're doing things in accordance with laws and regulations. And
So really, in order to be able to get the multiples that we've been talking about in some of our previous shows on this subject, if you hide this stuff, it's pretty difficult to get it back in the books, and you could end up paying long lost taxes that you didn't pay for. And if you don't put it back in and you don't show the real value, then you're going to sell your business for a lot less than it's worth. And so all you did was just hurt yourself later.
boy, that's an excellent point. Well said. And yeah, American companies are really good at minimizing taxes. For the most part, we do a really good job of that. And we take full advantage of all opportunities. But when you're selling your business, you're turning it upside down. Instead of trying to minimize profitability, you're trying to show how you optimize profitability. So all those adjustments that you made for tax have to be reversed to show the potential buyers what profit you really made.
Yeah,
Most
okay.
people understand that, but when it gets into this, well, I didn't record this revenue, I skimmed off the top, I think you're going to make a lot of potential buyers very nervous, especially when
Yeah.
you're selling equity rather than selling assets. Because
Yeah.
if you're selling the equity of the company, that means whoever's buying it is picking up all those potential liabilities that you were involved with creating.
Right, right. Including any residue you left around, or chemicals that have seeped into the ground, and all kinds of stuff that you never took care of while you were in business.
Absolutely. I think a good businessman has to be socially and environmentally responsible for what they do,
Yes.
and have to comply with rules and regulations. And if you think that you're getting away with something now, I wouldn't be surprised that eventually you're going to get caught on that point and you're going to end up paying penalties, and it could actually put the company out of business.
Well, and I just went through a potential buy of a piece of property with a client, and the price was really good, and they just jumped on it and went in and made an offer, and it was preliminarily accepted, and so they went through all the regular stuff. And after it was done, they found out nobody else had made an offer on the property. And then when they were in the due diligence part, they realized that there was a gas station across the street that apparently had a lot of leaks, and they felt as though the property, in fact, needed substantial mitigation. And therefore, if it doesn't seem real, many times it's not real.
Yes.
And that's what happened on that one. So they
It's
backed
funny
out.
if
Yeah.
as you saw here, I got this lovely view here in 1996 because the owner of the property had failed to pay workers' comp on his framing business for 4 years. And both the IRS and the state came after him for $400,000.
Yeah.
And, the poor guy wasn't going to receive anything out of this house simply because he decided he was going to play a game and he lost.
Right. Yeah.
Yeah, and it's extremely magnified in the state of California.
Mm-hmm.
And the requirements are so high and you're expected to meet them.
Hmm.
For instance, this the most recent rule change, I think it was AB 5, where they're trying to make more and more independent contractors employees, and you got to make sure you're following the rules and regulations. Otherwise, you got potential lawsuits. We haven't talked about those,
Yeah, right.
but then you're always got the risk of lawsuits out there if you're not paying people in accordance with wage and hour guidelines in the state of California. You're putting big risks on your corporation. Hidden liabilities that aren't on your balance sheet, but could be on your balance sheet if someone files a complaint.
So if you have a corporation and you sell the shares of that corporation, you could be picking up this hidden liability and not even realize it unless you've checked it out.
Yeah, absolutely. That's the problem. Buyers want to buy assets. Sellers want to sell stock. And there's a conflict in that process. But buyers obviously want assets because they want their hands clean. They don't want to be held accountable for any potential liabilities that are out there they had no control of.
Right, right.
Fortunately, you buy the stock. Guess what? If there's anything out there, you're responsible.
Hmm. So that liability is obviously something that you're helping them kind of mitigate, so that when they get ready to sell, the books are as clean as possible and demonstrate as much profit as possible, because that's where the exit multiples will come from. Is that correct?
That's correct. That's very well said. It comes down to two things. Number one, you don't want the owner of the business running the day-to-day operation of the business. You want him to be more as the chairman of the board. And secondly, you want that company to be run with good controls and minimizing any potential downside down the road for not meeting rules and regulations. There's so many rules and regulations out there you have to meet. You don't intentionally want to miss any of them. It's hard enough to make them all, let alone intentionally try to miss some of them. And some people think they're above the law, and I really don't get this, where if in the state of California someone is supposed to be an employee, you should classify them as an employee. Treating them as an independent contractor is a big risk to that business down the road. Because if you don't meet the requirements, and the requirements are very, very specific now, almost everybody who works for a company should be an employee.
Yeah, that's right. Yeah, that doesn't help business grow very much in California, but that's another subject.
Yeah, you operate in the state that you operate in, and you got to meet the requirements. It's easy for people in California to complain about the requirements being too high, and it's very understandable. But if you're operating in California, you have to meet those requirements. Otherwise, you're putting the business at risk.
Right.
Yeah.
This has been very helpful. So we still have 3 more steps to go through here. Ed, can you?
Number 5, and this is one how many people really think about. There's usually assets on the books that are not necessary to run the business. And probably the best situation there is to sell those assets and get the money and reinvest it into projects that help the profitability of the business. When you're doing a valuation of a company, you look at the future cash flows and come up with a value of the company, but you always add back any type of surplus assets that are on the balance sheet that are not being used for the business. So that's a good one. I think that's one that it's low hanging fruit for most people.
Can you give, without disclosing a company, can you give us an example of an asset that you may have run into that really helped increase the value of the business?
Well, sometimes they might have real estate on the books that they're not using.
Okay.
That should be probably sold or moved somewhere else. It's not really part of the business. Usually the balance sheet shows the assets that are necessary to run the business
Okay.
rather than anything else besides that. Number 6 is an interesting one. It's protecting the going concern. And I think a lot of businesses out there don't realize they have a big risk out there if they're a co-owner with somebody else. And let's say there's 2 people that own 50% of a company. Everything's fine and dandy when they're both able to participate in managing the business. Unfortunately, if something happens unexpectedly and one of the partners is no longer able to continue on in the business, it's a real problem because the partner who's left carrying the load only owns 50% of the business, which makes it really hard for him to manage the business in the future. And most importantly, now instead of having his long love or true partner in business with him who was helping him run the business, now all of a sudden he could have a family involved who know nothing about the business, add no value to the business, and think the business is worth 100 times more than what it is. And that causes all types of potential problems in the going concern of the business, and it could put the business out of business because there's no unification of ownership at the top. So they should all be looking at a buy-sell agreement. And then the last part, and I think most companies are really good at this, on lowering their taxes to whatever the least amount they have to pay. I think most people are pretty good about that. But there are some opportunities like research and development tax credit for manufacturing. I'm just shocked how many people don't utilize this. And I'm shocked how many CPAs don't bring this up to their clients. I think they're afraid of losing their clients. I look at it just the opposite. I think as a trusted advisor, our job is to protect our clients and find every potential opportunity for them that's out there. And sometimes it'll require expertise that we don't have. You know, one of our shows earlier was how to pick the right CPA. Well, there's a lot of great CPAs that know how to minimize your taxes that know nothing about research and development tax credit. And obviously they have to be more of a collaborator and bringing in the right expertise to take advantage of this opportunity. That pretty much concludes this, I think, a great driver for optimizing value in a company that most of the time, I think, doesn't get the any time in reviewing and understanding. And I really believe it's got a lot of potential. And maybe down the road in one of the future shows, we'll talk a little bit about the balance sheet and understanding it, because I think most people understand their income statement, but probably more important to the business is the balance sheet, because it shows what assets they have, shows their owner's equity, it shows the amount of debt. It's a very important financial report that I think most people really don't spend any time evaluating. And I give you this as an example. Usually on cash flow, you want your accounts payable to be as high as possible, and you string out your payments as much as possible without irritating your vendors. But I've been in so many board of directors meetings, and they say, "Whoa, our accounts payable are down. That's a good thing." And I always have to tell them, "No, that's a bad thing," because they really don't understand it.
You know, going through number one, freeing up working capital, as you went through there, it kind of brought back some bad memories for me. Because when I was in the retail business, I was having just tremendous growth. I think the second year we were open, we grew by 80% over the first year. And we continued to grow at like 40%, 30%, for many years. And what I didn't realize is that growing so fast that you can't self-fund that stuff. So just to kind of give you an example, when we were growing at say 60%, and then the banker loved me to buy more inventory, because his idea was that the more inventory you buy, the more you fuel those sales. It was as if if I could buy all the inventory in the world, that I would just get most of the business in the world. But it doesn't really work that way at all. Nonetheless, I was growing, but in order to be able to finance 60% growth, that means I had to increase my inventory by 60%, or I had to reduce my turnover or increase my turnover in order to be able to sell more sales with less inventory. And so once I sort of figured this out, that I could not make enough money to fuel that kind of growth, I went through and did all of these things. We got rid of in-house accounts and made everybody switch over to credit cards, even back in the day when people many times didn't carry a credit card, and they didn't want to use a credit card. We went to deposits instead of trust on special orders. I spent a huge amount of effort to increase turnover. Probably over a period of 4 or 5 years, to try and get turnover from a 1.9 to a 2.5. So we had a pretty nice increase in turnover. So we went from sort of the bottom of the barrel in the industry up to the highest performing in the industry, and that freed up about $500,000 of cash that I did not have to borrow. And so turnover was a big one. And then, of course, you say, negotiate a little bit more money. Well, I got really good at buying a bunch of inventory and then telling them that I would sign the order if I got 60 or 90 days. And then they would kind of go, oh, I don't know about that. And then they would see the size of the order and they would take it up to the boss, and somehow I'd end up getting those terms. Well, what I was able to do is, while I increased the turnover, about a half a time, I was able to increase the turnover of the money that I paid for it by about 1 or 1.5 times. So I literally created cash by doing that. And it was a good thing, because I had maxed out the amount of money I could buy. I had an SBA loan, and it was quite a large loan for those days. And I was paying it off, never missed a payment, but there was no more money to be had. The bankers would not hear of a loan. And so, I was going to, and it did, it slowed the growth of my business down, which was probably okay, because I was growing too fast. But in one case, I negotiated, we bought an awful lot from a particular vendor because we had a very special relationship with them, because I did a lot of design work for them. I was able to negotiate delivery of an entire truckload of merchandise for fall in the previous January. And so I got the shipment in January, and I got terms starting August 1st, 60 days from August 1st. So I didn't have to pay for the merchandise until well over 2/3 of it was sold. So it can happen if you get creative. You can do these things.
That was
I
really
think
good.
that's if I can, Ron, that was a great example from perspective that you were able to do. And I didn't mean to interrupt as much as Ed, help people understand what this can mean to their business. Because I've had the privilege of watching you internally in a business using the strategies that Ron was talking about, and these other things has a huge impact on the bottom line. So if you can share a little bit about how the difference this can make.
Well, I really enjoyed hearing Ron's amplification of his experience on this. But what I really, in addition to all the good points he brought up, one other one is really important. The stronger your balance sheet is, the quicker you can move on potential opportunities that come up down the road. And as we all know, opportunities pop up from time to time. And there's an opportunity to buy something maybe half the price of what it normally sells for.
Right.
Under the caveat, you got to have the money to buy it now. I'll go run into the bank and asking for a special loan from them, because it ain't going to happen in time.
Right.
I have that money available, ready to move on it, and you can pick up a lot of really good opportunities for the company by having a strong balance sheet.
Yeah.
And everybody, all bankers want to deal with companies with strong balance sheets. They don't want to deal with
That's something that I did not understand until years later. And, I'd go in and have a conversation with a banker and tell him all the good things that were going on. But he'd go right to the balance sheet and he'd say, but your equity hasn't gone up very much. And of course, there were times when I was pulling, maybe more money out for myself than I should have. So it took me years to really understand it. That's something that very few, in my experience, working with hundreds of business people, that is one of the least understood things of financial statements. That sure, they can read them and they can kind of say, okay, here's my equity, but really understanding how the equity rises and falls, how depreciation changes that, what the market value of equipment and assets really is compared to the book value. Those are all things that I would say 1 in 30 small business people understand that.
And more importantly, Ron, I think the thing that makes Ed's knowledge so valuable is that, he's been there and he knows how this works. And as he said, in just a matter of a day or so, Ed can look at a company and say, look, here are several ways in which you can improve your value. And as you pointed out, as a young man, had you had access to some of this advice, it could have made a huge difference for you, just as it will for some of these other companies. And I think one of the things that, having seen a little bit of what Ed has done and understanding how it works, in one case, I believe we were able, actually, Ed was able to increase the bottom line by 8 times, which seems almost absurd. But, when you take the experience that he has along with these opportunities, it can have that kind of a dramatic impact.
Yeah, it just comes down to really understanding your business and looking for ways to make it better. And if you're so in the weeds, you're just trying to get a new order in, or you're trying to satisfy customer A, we had a problem with one of his deliveries, you really have no time and no focus on that, which is extremely important in running your business. So I really believe you need a strong CFO type, but most businesses can't afford a CFO. And therefore, it all is in the lap of the owner. The owner has to be the CFO, the chief revenue officer, the CFO, CEO, CIO, and nobody has got skill sets that mimic all those job responsibilities. So you really have to bring in some expertise as needed to help you move the company forward. And I think that kind of dovetails with the requirement that we have in trying to get the owner out of the day-to-day, more involved as a board of director chairman, and getting other resources in the operation to identify these opportunities and help execute them so they're adding the full value to the bottom line.
I once had one of my clients tell me, he said, I wear so many hats I can't get through the door.
Yes, that's probably very true. And I don't know how you do it. So when you think about it, everything
you have to duck and kind of crawl on your knees in order to get that done. Yeah.
I mean, if you're running a business, most likely you're going to be spending almost all your time with your customers. And I would hope so.
You
And
should be.
that's extremely important. But when you spend all your time with your customers, who's focusing on this?
Right.
Most of the time, nobody's focusing on it.
Well, I think the irony of what we're talking about here is that, Ron, you kind of alluded to the fact you wish you had known this years earlier. You've always done well in business, but if you'd known some of these things earlier, it would have helped you as it would have helped all of us. And I think the point we're trying to make here is that, with the right advice, you can transform your business in a short amount of time. And it doesn't need to be full-time advice. It just needs to be critical advice that's related to small things that can make an enormous business. And I thought maybe as an interesting segue, you talked about some of the benefits of tax credits. Perhaps next week I can talk a little bit about the employment training tax and how you can use that to develop the skills of your workforce as you move forward to get more from them out of the time they actually spend with you to do what you're talking about here.
Yeah, that's another specialized area of opportunity, Ray, that normal trusted advisors, normal CPAs don't really understand.
Yeah.
And they can't help their clients realize something that they don't understand. And they're very reluctant to bring in other people to help their clients out. So there's a perfect example, and that makes a big difference for several reasons. Number one, you can get significant funding to do the training, but most importantly, it gives you an opportunity to spend more time on training, and training is extremely important for increasing profits.
Right, right.
And one thing I just want to emphasize is that I always tried to focus on sales, even though I didn't really enjoy that. But the reason is that I could hire people to handle the books, and I could hire an attorney, and I could hire an insurance guy. And so I always tried to hire all the people that could do the things that I didn't like to do or I was not very good at, knowing that I knew more about how to put the right products in the customer's hands than anybody else. And so I ultimately spent all of my time on that, really controlling inventory and buying the right goods for the right customers. And so that was really quite helpful in order to keep me focused for at least the first 3 or 4 or 5 years, until we had managers in every store. And I could farm out the training of our salespeople to the managers, and ultimately I farmed everything out.
Right.
With the exception of the buying, which was the key to that particular business that I'm speaking of. So yeah, but in all of the businesses that I've had, the first thing that I've always done is hire a CPA to help me start it, to make sure that I get it going right, and to farm it out. Because even though I probably have better bookkeeping capabilities than most business people, it wasn't worth my time to do that, because my time was much more valuable building the business than it was doing bookkeeping. So,
but you can see just by this list alone, just one of the 8 drivers, you can see the potential upside of your business by somebody focusing on this, whether it's part-time, full-time, whatever. Somebody needs to focus on this. And as we talked about during our session on getting the right CPA, normally CPAs don't focus on this type of stuff. They focus on taxes primarily and audits. Here you need expertise from a CFO perspective on how to operate a company. And so getting that expertise in your company, a lot of these companies have a good controller, which is necessary for closing the books. They have a good CPA, which is necessary for minimizing their taxes, but they have no expertise on the CFO side of the house to help them gain these incremental improvements to their operation.
Yeah, and in my experience is that CEOs get very good at doing things they shouldn't be doing at all.
That's
So I think with that, I want to thank Ron and Ed in particular for having walked us through this. Let's next week we'll kind of dig a little deeper into one other aspect in which they can access funds that are theirs anyway and help develop the skills of their workforce so that they can focus on these things that are really important instead of the day-to-day stuff that drives them nuts.
well said.
Okay,
Thank you.
that's it.
Bye.
Thank you.